Hello and welcome everyone. After making a first video, my lot of friends asked me about mutual funds. So instead of explaining one by one, I thought to make a series of video which will cover every basic aspect and terms of mutual fund that each one should know before they start investing. This series will cover 7 to 8 videos, as if I put everything in one video then it will be around 2 hours. So I am splitting into parts starting from what is mutual fund to how to pay taxes in mutual fund. I'll cover all the topics in theoretical as well as in technical manner. So let's start with the video. The first thing is, what is mutual fund? You can think of an organization where you give your money and they invest in market in your behalf and help you in earning profits. Now the organization which invest our money is called mutual fund house. There are around 40 plus mutual fund houses in India like SBI Mutual Fund, Quant Money Managers Limited, Mirai Asset, Canara Robeco, and 40 plus others as well. In every fund house there is three category: debt, equity, hybrid. Now what is debt, equity and hybrid? Debt funds invest in government bonds or corporate securities. Now the question will arise, what is government bond? In simple words, you can think like you are giving loan to government. Government will invest your money for new projects, infrastructure, and they will give you interest rates. In debt, the risk is lowest compared to equity or hybrid. However, the returns are also in lower side. This is advised for short-term investment. In debt, the average return rate is around 6 to 6.5%. Now equity. Our main focus will be on equity mutual fund. In equity, our money is invested in purchasing stocks of different companies. Here returns are dependent on the companies where our money is invested. Returns are much more higher than the debt funds. Here average return rates are 12%. But you but if you invested in a good equity scheme, it can go up to 20 to 25% as well. As the returns are more, the risk is also more here. But in longer terms, it will be profitable only if you have researched and invested properly. If you are looking to invest in equity, you should set your mind that you are investing for more than 10 years or even for 30 years. Next is hybrid. Hybrid is nothing but a combo of debt and equity. As I told, our main focus will be equity. In equity, there are several schemes, mainly small cap, large cap, mid cap, flexi cap, ELSS, and etc. I'll tell about each type one by one. So the first is small cap. Small cap have market value of around $300 million to $2 billion. Similarly, large cap has a market value of $10 billion and mid cap will range around $2 billion to $10 billion. In small cap, these companies are usually the smaller companies where your money is invested, so the risk is also higher here. But the returns, you can see the returns are also high in for the small cap mutual funds. Now the large cap, here the risk is low as your money is invested in the stable companies, so the risk will be low, but the returns will be also low as compared to the small cap. And in mid cap, it will come in between the small cap and large cap, so the risk will be moderate and returns will also be moderate. So the next is the flexi cap. In flexi cap, the fund managers have the freedom to invest your money in any of these companies like small cap, large cap, or mid cap. And now the ELSS is equity linked savings scheme. The money invested here can be used to show in investment under ATC of the income tax. And there are other schemes running as well. With each scheme, there will be a fund manager which will manage the investment. It is also possible that in one scheme there is more than one managers, and it may be the case like one manager is handling several schemes. So this concludes our first video. I'll be back again with another video in this series. If you haven't subscribed the channel, please subscribe it so that you will be receiving all the notifications of the next video. Till then, bye bye.